Hi, welcome to this episode of insurtech of VC, PE, and M&A. Today we have Jeffrey Fidelman on the show. How are you today?
Doing very well. Thank you for having me, Jeff.
Well, thank you for coming on the show. And you reached out to me on LinkedIn, I believe. And when you told me of what you do every single day, and I was like, man, our audience would just love to hear from you. So I'm going to turn the mic over to you and let you introduce yourself to our audience and give us a background of what Jeff do and how'd you get started?
And I guess I'll give the medium version since I have the latitude here. So Jeffrey Fidelman, my background, I graduated from Harvard. I spent more than half a decade in banking between Morgan Stanley and HSBC. I was then recruited to a family office to help them launch a venture capital fund. And the focus of the fund were early stage companies that were either tech or tech enabled, which we would help anchor and then syndicate the rest of the capital. And in 2015, I left to start an investment bank focused on the similar field of early stage companies. And since then, we've grown to about 40 people, all remote, US and Canadian based, and provide advisory services where we help our clients put together their decks, models, valuations, all their fundraising materials, preparation for a fundraise, and then helping them actually execute on a capital raise as well. We take a little bit of a different approach where we call it fundraise as a service. Effectively, we have a CRM that aggregates data from PitchBook, Fintrix, Preqin, all of the other investor databases, and have an analyst that becomes an extension of our client's team so that Alex, the analyst, calls from ABC company or emails from abc.com, so that from the investor's perspective, it's the company that's reaching out to them. So I'd like to think about that as almost outsourced investment relations or in-source investment relations in another way.
You're in the world of investment banking, and there's so many niches and fields. What made you say, you know what, insurance is what I'm going to plant my flag on?
So we were talking about this earlier, and I think it was more planted on me than me on it. I was initially exposed to insurance just as a product when I was in more institutional investment banking between Morgan Stanley at HSBC. And shortly after leaving the venture fund, when starting this company, there were a few engagements that we took on that were really kind of traditional legacy insurance related. One of those engagements was building an insurance carrier for a very niche product in commercial real estate residual value insurance. And that was something where we flew down to Bermuda, got a Class 3A carrier license, needed to raise capital for that, needed to then, really interestingly enough, work with the market where, on one hand, needed to get reinsurance just in order to take on massive amounts of risk that we were starting to build a pipeline on. And on the pipeline side of sales, they wanted to make sure that we had a reinsurance carrier that was S&P or Moody's rated behind us. And it was this game of stuck between a rock and a hard place. I needed to build pipeline in order to get reinsurance. I needed to build reinsurance in order to get pipeline. And that was kind of my first introduction to real estate. I did not wear shorts and a tie and shirt and button down in Bermuda. Unfortunately, I never had the chance. But we ended up financing that company and then selling it to a very prominent private equity firm. And since then, I have just carried that experience and have multiple engagements over time where insurance companies to proper insurtech companies that were providing guarantee and warranty insurance on one-click checkouts to now working with an MGA, a new MGA that's being structured to put a product out that has also to do with real estate. I can't talk too much about it, but is a brand new product that hasn't been done before. And I just find that insurance, once you understand the structure of really how it works, I think Warren Buffett said it best and probably knows it best, where you just want to end up collecting more money than you end up paying out. So once you understand that as kind of a fundamental truth of insurance, it's just about risk management from there in terms of creating new products or a business around or in insurance.
So I'm going to go off topic for 1 second. What's your experience like visiting Bermuda? I mean, like a lot of people don't understand how much insurance happens in the world of Lloyd's of London and Bermuda's.
That was actually my first. I never vacationed there or visited prior to going for work, funny enough. And with with people that don't have understanding or exposure to Bermuda, like I hadn't before, I always thought about it as a vacation place. And the reality is the entire island is insurance and reinsurance companies. From a legal and regulatory perspective, most reinsurers or insurance carriers will be based in or headquartered in Bermuda for a variety, for those and other reasons. So when you go there and you want to speak with or have a conversation with anyone that has to do in reinsurance, ranging from, and this is many years ago, but like Renaissance Re was located there, AXA was located there, everyone, like every big company, Markel was located there, had an office there essentially as kind of the headquarters and where you needed to get licensed. So everyone had an office there. Everyone had an account there with one of two Bermudan banks. I think Applebee's maybe was one of them. And the island in and of itself is it thinking on it now, it kind of reminds me a bit of Miami, where everyone there is for some element of business, but everyone there is almost always at either a breakfast, lunch, or a dinner.
Bringing back into what you do now. At what point did you start to advise founders in the insurtech world? Insurtech kicked off what, 2015-ish? 2016?
I think so.
What's your earliest memory of getting into the insurtech world and then advising with founders and building a community around you? Thank you for watching this video. Now a quick message from our sponsor, Mav.
Thanks, Jeff. I want to let you all in on a secret that top producing agencies don't want you to know about. If you're in P&C insurance, you know firsthand how much you're getting squeezed by your call center. It's becoming less predictable and less economically profitable to scale. But here's the thing. The top producing agencies making over $100 million are not running their leads through a human-based call center. They're running them through an AI expert like Mav to qualify, quote, and hand deliver the highest intent qualified leads to your agents. Mav takes care of the back and forth, having unlimited 24/7 conversations with your leads that are personal and relevant so you can scale to the moon. Ready to ditch your call center and 10x your agency? We're giving the listeners of insurtech's $15,000 worth of credit to try Mav. Head to hiremav.com/insurtechs to claim this offer.
Probably around that time. I want to say around that time because that's when I left venture and started going into more kind of consultative and investment banking work. Early on, I was exposed to insurtech right away. And there were really niche products around short-term guarantees. And a lot of it had to do with, not to anyone's surprise, with marketplaces, with internet shopping, with consumerism changing to digital. So you had all of these other insurance products that needed to be created in order to justify price and also ensure customer satisfaction. So making sure that products received by customers on time. And I know that, now we see a lot of these things about Amazon package thieves or package thieves coming off of doorsteps, but there are insurance products for all of that are relatively recently created because that wasn't as big of a business as it is now. So when thinking about a lot of these products, one of the biggest issues 10 years ago was that insurance carriers kind of were very traditional in how they looked at risk. So unless it fit into a very square bucket, or rather square set of criteria that they had, or a bucket that they had, they weren't willing to do it. And that was the biggest roadblock. It was less around regulation. It was more about insurance carrier and reinsurance carrier adoption of certain products when they were actually getting taken to market. And fast forward 10 years later, I mean, quite frankly, fast forward 2 or 3 years into it, and you saw a few insurance carriers that started to become a lot more friendly to digital solutions, to what was before a very either manual or a very kind of in-person, face-to-face process. You also had technology start to become smarter. I mean, now we have age of AI, but even prior to that, if you're looking at certain insurances like weather, hurricane, tornado, all of these kind of acts of God or natural disasters, now you have a lot more data and a lot more models that can start to predict those things. Once you start predicting those things, you're now able to have a dynamic premium system for different customers, different geographic locations, different ways to actually measure risk. So it sounds strange, but insurance, probably like legal, probably like real estate, are some of the more slow to adopt new technology. When they do it, when they do it rapidly, but we're slower to adopt that new technology. So and that's why you have a lot of these MGAs and MGUs come out. Well, you spoke about that point earlier, where they were able to create these products, effectively get lines or risk capacity from insurance and reinsurance carriers. And now those products are being absorbed, because it was a lot easier for an MGA to create a product to actually run that claims system and underwriting system on their own with the technology and the data that they were creating, all of them being proprietary and all of them kind of feeding into the ecosystem of insurance and reinsurance.
I have so many questions. I'm just like popping in my head while you're talking, right? So no particular order. What round do you participate with the most that founders come to you say, hey, Jeff, I need your help with this round? Seed, pre-seed, Series A, Series B, which round do you find yourself in the most?
When it comes to insurance types of products, most of the time, probably seed through Series A or Series B, but usually on the seed stage. Pre-seed, I don't know that. It depends, I suppose, what the product is. If it's insurtech, where you are infrastructure or that is not regulated and it's purely like a technology solution or application, that's one kind of set of circumstances. On the other side is where you do have product, where you do have regulatory and compliance or regulatory compliance items that need to be considered. So there's a little bit of a different formal way to apply those things. On either side, with the technology piece, pre-seed to seed, because pre-seed is a little bit more applicable. When it comes to the MGAs or insurance carriers or anything of that nature, pre-seed is less applicable, because usually the people that are starting those companies are already relatively capitalized to have gotten to that point. And anything going forward is really around like growth and expansion, marketing or distribution, or it's around just capitalization of either creating a captive to take on risk on the back end or furthering relationships with the carriers that they're working with.
When you're taking on a founder or multiple co-founders, that first introduction call, what do you look for? I'm sure you're turning people down at the same time, but the people that you work with, like, what do you look for?
Passion. And I know that is very relative to anyone, but I think passion, if someone's passionate about what they do, they will be successful. I think that it's a common denominator that I've seen. And passion comes in all ways, shapes, and sizes. But when I say about passion is genuinely believing in what you're selling, believing in whatever you're doing will, not out of altruism and help everyone, although it should, or help the system in some way, shape, or form, but it will make money. And understanding every step of the operational workflow of that product being executed, whether it's a digital product or an actual insurance product, is incredibly important. So knowing, how am I going to get distribution of a product? And this is prior to like launching even a business, right? Like you should have these things in mind. So coming up with a distribution strategy. Who is going to buy my product? Why are they going to be buying my product? A sense of measurement of demand, right? Like, it's not okay to say, if we build it, they will come, especially in insurance, because it's not easy. It is expensive. So thinking about it from the other perspective of there is a demand for this, there maybe have some conversations, but this is our distribution strategy and this is who's going to buy it. Having the ability to understand who is going to be backing you as well. So trying to rush into things very, very quickly doesn't make a whole lot of sense with insurance, because you need a carrier behind you or a captive behind you, or a pool of money that you're able to raise that can create the same situation to actually provide this insurance product.
Let's just say I'm a founder, right? And I'll say, hey, Jeff, I need to raise money. I have this idea, AI agent gonna produce a bunch of insurance. You're like, Jeff, what's your execution plan? What's your business deck look like? We walk through all these things. I'm pretty sure you guys are fee-based, right? Just like everybody else. But how often do you say, you know what, let me also take on shares, right? Do you guys operate on shares and fees with your founders to invest in their success and go with them on the long run? Or is that something that's not a practice?
So we do take fees as well as advisory fees, meaning participation in any successful capitalization. Those we have the right to convert into shares into that round that they're getting capitalized in. There have been a few entities, the insurance carrier that I mentioned earlier, a company now that we're working with, that we are taking a participation in the business itself. From an advisory perspective, and not to interrupt, but from an advisory perspective, I want to make sure that the right thing is being done. And
Yes.
to give someone equity for a one-time participation that doesn't add any value doesn't really make a whole lot of sense, right? Just to give someone shares for something they did at a single point in time. And then now those shares are dead shares. They're no longer working for the company. From an advisor perspective, that's what I would say. From a recipient perspective, of course, like I would love to have dead equity, so to speak, until there's a capitalization or liquidity event. But I would rather tie, and I've always rather tie my compensation with the business actually growing, right? Like I have a fundamental belief that if the people that I work with or that are around me are making money, I'm going to make money as well. So I'd rather tie comp in that type of structure, in that type of way, where as long as the business keeps growing and I'm helping that happen, then I'll participate in it, even if it is setting up a 1 or 2 early relationships.
You said earlier you guys have 40 employees.
Yes.
What do you look for in your hires?
Interestingly, on the banking side, for a while, we were hiring proper banking analysts to do a lot of the calling, a lot of the outreach, the things that I mentioned earlier. And what I found was a lot better conversion from like BDR and SDR types of people or types of background. We hire analysts that are former BDRs and SDRs to kind of start on an analyst level. We promote internally. So from analyst to associate to VP and director and et cetera. And it's really has been incredibly important to us, especially as a small firm that continues to grow, that there's no one managing you that hasn't done your job before. And might that change eventually? Look, I'll never say never, but it's really and has always been important to me, even coming up myself through banking, through other things that I've done. And even seeing it now a lot of times when I have founder reviews and they talk about their pitches to certain investors, like if the person managing you or if the person who's responsible for you has never done what you've done before, it makes it that much harder for them to actually manage you. Because saying work harder or do more or perform better is so relative, and it's such an impossible command to give to a subordinate when you don't actually know what they're doing or how they're doing what they're doing.
That question answer was 10 out of 10. That was a really good answer. I liked it. Switching gear for a second. You're in New York, right?
I'm based in Connecticut in Westport, but I'm an hour outside of New York. Yes.
New York, from last time I read this article, have about 8% of total investment funded in the insurtech industry, insurtech community. And 70% of it is from the West Coast, where the money comes from. How do you see the industry trend goes as far as like founders in the East Coast area versus Silicon Valley in the insurance world versus where the money comes from, where the money flows?
I think especially in insurance, it's quite distributed. You're not necessarily going to be meeting with insurer tech investors in Bermuda, right? I'll put it that way. Obviously, even the stat that you had just said. I'm a bit surprised by the overwhelming amount there, and I wonder if that's across all insurance, including insurtech, or that's purely on the digital product. And if so, that maybe makes a little bit more sense where there's just more funding availability on the West Coast for those types of like digital products. And they're starting Silicon Valley or maybe even in Los Angeles or other places. I think at the end of the day, especially when we were putting everything together, I can tell you that at least from the Northeast perspective or maybe East Coast perspective, New York is like the capital of insurance. Everyone we needed to meet with has an office there. And I think fundamentally that is that is the reality of New York, that it's a main hub, if not the headquarters, and it's not the headquarters for so many different companies. But what it does have is an office with very high-ranking people of every company. And if it's not in New York, it's immediately outside of New York. I think we met with, maybe it was AXA. They have an office in New Jersey, for example, and they're a very large firm. So there's a few bits and pieces here and there, but all of the main brokerage, advisories, private equity firms, and placement agencies are located there or here, kind of in the Northeast area in the corridor.
I think this could be an episode all by itself, the New York community of insurance and insurtech. Is there any story, like war stories, you can tell us of some of the most impressive founders you have met and advised over the years? Thank you for all your support to our channel. Here is a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
Well, I can probably many, none that I would want recorded. I'll put it this way, or rather, I have one, and if someone I'm working with right now. It is again, without going into too much detail, a group of attorneys have been doing or having a very niche practice in residential real estate for quite some time. And they recognize the gap that could easily be filled, that hasn't been before, that have adjacent types of products in the industry, but not this one in particular. And having worked with them now for probably a year, maybe even over a year, it's been incredible to see how that narrative has come together from doing something adjacent in practice in what they're trying to put together, and how that story has come together to really form a proper insurance product. And I mean, I'm really very excited about it just from a loss and risk ratio of what that product looks like. But effectively, they took something that they've been practicing on for years, that they have been ideating on for a number of years as well, and slowly starting to collect data without disrupting their normal course of business, but more than just taking a mental note, but taking an actual note. And they've built this incredible set of data over the course of a number of years prior to even coming to me and saying, oh, like, look, this is essentially the demand that I was talking about before in one of your earlier questions, that if we take this data and reverse engineer it into an insurance product, then the payer of these insurance products can essentially save 80–90% on the dollar on a year-over-year basis. And as that started to ideate, that's when kind of they came to me, and we started working on the narrative on what that actually looks like and how that product can create some liquidity, and now being able to take it to market to carriers and reinsurance carriers. And we've been really, really, really fortunate to work with a few great third parties to help us navigate that market.
Flip the question, instead of helping founders raise, how often do you help founders exit?
I don't. So we do very, very little M&A. One of the third parties, I'll name them, I'm happy to, it's TAG, Financial Group, TAG. They would be the people that we would refer to on an exit. We work closely with them. They are the ones who I mentioned help us go to market with these carriers once they're ready to. And they would be the ones that focus more on M&A activity.
Yeah, I was just thinking, since you have the journey, the relationship with the founders, there's sometimes people just get burned out and they say, you know what, I'm ready to go to exit, or they build for that one day, right? So,
well, look, you're either building a lifestyle business, which is absolutely fine, and then you probably get taken out later anyway into retirement, or you pass it down, or you're building something to sell specifically. And And, with insurance, if done right, either way, you can make a ton of money if done right, I think is kind of the key term.
What are some of the things you advise your founders on when it comes to board of advisories or board members?
Make sure they add value. All too often, I've seen companies put board of advisor individuals or board members as individuals on, where it's an incredible name. I mean, Jamie Dimon, Elon Musk, right? Like, I'm being facetious with those specific people, but very well-known, recognized names, either in insurance or other industries. And maybe that person has said, yeah, sure, I'll be a board member or board advisor here, and never meets with you and does nothing for you, then that is dead weight. It doesn't matter what that name is. Make sure that whoever you do bring onto your board is providing active value. Any third party, by the way, like a lawyer is a lawyer is a lawyer, get one that's going to work for you, not just respond to you. Right. In the same way, you should look at your board of advisors or whatever you want to call that group of people that you're bringing in and putting in your deck or saying that they're affiliated with you. Make sure they're doing something for you. And again, make sure that you're not expecting them to do it out of altruism. There's probably warrants or equity or some sort of compensation that should be considered there. So that's really important as well. In my experience, nobody works for free. So either bring on a board member where they have an adjacent business in that your relationship with them helps their business and in turn helps your business, or bring on a board member that knows, or they have certain access or fill a gap for you that you do not currently have as a leadership team, and be prepared to compensate that person for those relationships that they're going to open to you.
On an average case, when you take on a founder, how many people are getting an email with a deck, and how many conversations do you usually see them happening? What is the number of
I'll answer you in reverse order.
Okay.
Once we get kind of the engine going, and again, from our perspective, outsource investment relations would be the same as if you, the founder, the listener, imagine you're putting together kind of an IR team. You have to get an analyst who does all the outreach. You have to get access to a database. You have to put together all the infrastructure, the calling, the CRM, all of that. That's what we take on, and our clients rent from us month to month. Once that engine gets going, pipeline built, and all the data is ultimately our clients, and they have visibility to that, we expect about 2 to 3 net new investor meetings on a weekly basis.
You said weekly, 2 to 3.
Right, yeah.
And what's your average rejection rate for some of the most successful round that you have invested in, built in? Some say 100, at least 100 plus, right?
No, that's a tough stat. And you mentioned something earlier in terms of decks sent. So there's a lot of psychology in this, or at least I think about it as psychology. We don't send decks unless explicitly requested when we're raising capital for a client. And it's best practice not to do it. Because if you're able to get someone's attention and for them to book a meeting with an email and a few bullet points, then sending a deck only gives that person the opportunity to say no and cancel the meeting. That's before you even go to it. Now, of course, if an investor says, send me the deck before we meet, or send me the deck before I make a decision, then of course we send the deck. It also gives the fundraiser, the person raising capital, the client, the opportunity to go through their pitch on a call, on that meeting with the investor, and then offer to send them the deck afterwards for review. And as long as the investor says, okay, of course, send it over, I want to review it or request that from you, you sending that deck is kind of like Psych 101. You sending that deck fulfills this micro promise that you made. You said you were going to send the deck. And he or she, the Mr. or Mrs. Investor, said that they were going to review the deck. So as long as you send it in a timely fashion, there's a lot higher likelihood for the investor to actually review the deck prior to your next meeting, or at least to provide some sort of feedback. So that's kind of the approach we take to kind of sending a deck versus not sending a deck, and when to actually send a deck. Don't do it in your cold email. Just try to get the call actually done. And then when you do have the call, use that deck as the ability to set your next meeting, right? And that's now go to Sales 101. When I was at Morgan Stanley, or even before that, we were cold callers, and they told us there's 2 ways you hang up the phone. They hang up on you, or you make the sale. So that's kind of the mentality we always went into it.
That's good. So looking back in the last 5 years, 2020, 2021, I mean, the world of VCs are red hot, right? Everybody building funds and check was just written. Post-war with Russia, Ukraine, market tightening a little bit. Some people say there's still a lot of dry powder out there in the market right now. As of this recording, right, April 2025, how would you describe the marketplace right now?
Apprehensive. There is a lot of dry powder out there. I think the last count I saw was around $2 trillion. That's between IPO or just IPO companies that are attempting to go IPO, to private equity, venture capital, and private funds that are holding dry powder on the sidelines. And up until this year, this quarter, the past couple of years, you've seen an incredible market acceleration where LPs that are sitting in these funds are making higher returns in an ETF than they are in a private equity or venture capital fund. Not to mention that the funds themselves have been sitting on that cash, not deploying it as rapidly as they have in years prior, certainly in 2021. And a lot of these funds, what they do is when they raise capital, there's a 5-year deployment window. So to your point, a lot of these funds were getting checks written into them in 2020, 21. Now we're in 25, going into 26 next year, and these deployment windows are coming up. We see a lot of continuation funds coming out. We see a lot of secondary investments happening as well. And that is just because these funds need to get rid of need to actually deploy their commitments. Returning capital to LPs is a lot of people say it's a death sentence for the fund managers that's doing that. There's dry powder. In my opinion, there's pressure to deploy that dry powder. When that bubble pops, and we saw it start to actually increase into fourth quarter of 2024 and slow back down in first quarter of 25, this past quarter, in terms of deployment of capital into funds or into private companies. But there is pressure there, and there's a lot of available dry powder.
That's pretty exciting news for every founder that's about to, go into the market to raise money. The people that you work with, what percentage of breakdown would you say is insurance product focused versus insurance technology focused?
Of the insurance companies that we work with, 60-40 on product.
I heard a couple of VC talking, this is at a conference. They're like 2024, 2025, if the first page doesn't start with AI, we're not interested. Of course, they were probably joking. I hope they were joking, but what do you say?
No, I sent an article today, and I don't want to misquote it, but it was a pitch book article that I received. 60% of global and venture dollars went to AI, which is an insane stat.
A big number.
And you know what? I mean, look, this is one of those situations where someone once told me, and I don't remember what year it was, maybe 2012, 2014, something like that, that they invested in a digital insurance company. And he was like, but it's my ESG investment. And I'm like, what are you talking about? How do you make that work? He's like, well, it saves paper, right? So it's an ESG investment. So nowadays, I'm fully behind AI, and even something you said, in my opinion, there has never been a better time to start a business, is right now. I'm not going to give an entire dissertation here, but if we look at economic cycles and advancements in technology and new types of commerce, we are now again at an inflection point that we've seen over the past couple of years, half a dozen times, right? Like 2001, you had internet bubble and the survival of the fittest happened. 2008-ish, or plus or minus, 2006 through 2008, you had Facebook come out. Then a few years later, you had ride sharing come out and different types of marketplaces in 2011, 12, right? 2015, you had the idea of ICOs and blockchain really start to hit more mainstream. COVID hits, remote work becomes actually viable and more prevalent in a global workforce. And now we're again at an inflection point where AI is really starting to augment an incredible amount of workforce. And not only augmenting companies that are, let's say, replacing people, and that, of course, will cause disarray, but out of that type of disarray, people will be able to use AI and build products. I can tell you from personal experience that we were building a CRM internally. We were quoted at 1.6 months and $250,000. And I have, let's call it medium technical skill. 2 weeks and like $300 later, I have like pretty much the equivalent. It wouldn't have been possible 5-6 months ago, granted, but that's the speed of this advancement. So sorry to interrupt, but like the last thing I'll say on this point, and I really do believe this, like I'll drop the Wayne Gretzky quote, skate to where the puck is going, not where it is. If you're building a company now, do not build to solve a problem that exists today. Figure out a problem that will exist tomorrow and start building there. Start building towards that. Because by the time you build it, and even at the speed of incredible increase we're building stuff now, technology will continue to increase as well. Data, ingestion of data, digestion of data. So build to a future problem. Don't build to an existing solution.
Something you said maybe like a minute ago, I want to go back to. When crypto was rising, and everything was about Bitcoin and blockchain, which two separate area, and everyone was like, okay, the future of data is on blockchain. We haven't seen that taking over the insurance arena. Is it happening in the background that nobody's talking about, or like
it is.
I haven't seen
There's
that
a
many.
lot of blockchain.
It is.
There's beginning to be a lot of blockchain. I mean, they're maybe not in very mainstream yet, but more in terms of like authenticity, even like luxury goods and how you ensure those types of things, how to declare them, how to like underwrite certain things. They're beginning to implement blockchain into those. Certainly, again, as I mentioned before, right, like MGAs were the path, and I'd be curious. I'll do the research after this, but I'd be curious what percentage of insurance premium revenue comes through MGAs like over the course of time versus direct. MGAs, MGUs versus direct. But the same way how I hypothesized that MGAs and MGUs were the gateway of new products into insurance carriers, so too will be the way that blockchain gets in. It will be done on certain products, niche products. They'll be absorbed by larger carriers or MGAs, MGUs, brokerages, and they will start applying the same technology or transaction technology, whatever the case may be, to other products that are within those companies.
The other thing that people talk about back in 2020 and 2021 was, instead of having these funds that we've been seeing, right, registered security funds, that we would see more pools, right, tokenized pool, and that hasn't really happened yet either. That's at least not in the insurtech fundraise.
I don't know why. I don't have enough exposure, nor have I had the reason to go very deep into it. But the whole idea of like, why is title insurance not on a block? Why isn't there like a token per address that you can just, or an NFT per address that you can just track and use that for title insurance purposes? It seems relatively simple enough when you think about implementation. But then you think about every county, every zip code, every postcode has their own probably like physical tax map that hasn't even been digitized yet. So I think possibly one of the reasons, and perhaps I'm reaching a bit here, is just the disaggregation of information. And in order to implement blockchain effectively, you have to do it in a binary fashion. It's all or none. And if you can't do it for all, then you do it for none. Possibly. I mean, again, like I said,
that's a good answer.
I might be reaching a bit there.
No, I only asked the question because most people cannot answer that question. So I asked you that question. It's a hard question on why it isn't happening at a speed that we think it could be happening. But that was a really good answer, actually. Man, I think I can keep this going for like another hour, but we try and keep our show 45 minutes within digest period. And Jeff, I love this podcast. This podcast was very thought-provoking, got me thinking about some things. I'm definitely going to have you back maybe at the end of this year, like a Q4, and then we can do like a reflection of 2025 investment banking in the insurtech world. Are you going to be in any other conference, convention coming up?
No, have been head down. We recently, I think I mentioned this product, this CRM that we've been building in database. So we recently launched that. I've been head down focused on there and doing a lot of these podcasts. We'll probably be around towards the end of the year, but nothing planned just yet. Besides, like I said, I'm here in New York, so it's like a conference there every
Your
other day.
backyard. Yeah, it's in your backyard. Well, if I'm ever in town, I'd love to grab coffee, and pleasure meeting you over Zoom. This has been really fun. So I'm looking forward to this episode drop. And if you heard this episode, make sure you go follow Jeff on LinkedIn and follow his company. Thank you very much for coming on.
Thank you for having me.